Good afternoon, everyone. It's great to see so many attendees in our webinar here with regards to the top 3 dividend stocks for January 2023. It's a very discussed topic. A lot of our clients have been asking about what exactly we should be looking at going forward into the year. My name is Marcos, the portfolio manager here at Stock Specialist, and I will be actually joined, it's pretty much just by myself for the vast majority of this webinar, but I will be having a special guest later on at the end of this webinar to discuss one of the hidden gems that we've found in the stock market of January 2023. But just a bit of housekeeping, as always, guys. Stock Specialist, obviously this webinar is just general advice only. Please, if you require any personal financial advice, feel free to get involved and ask any of your registered brokers or financial planners. So next, starting with just the agenda for today, I'm going to give a really quick recap as what's been happening. And of course, a lot of people have been asking about our 6-month forecast as well. A lot of clients have missed out on the previous forecast that we made. And you can see there the 3 tops that we have here. Stockland Group is SGP. I'll be going into that one a little bit later on in the REIT space. Deterra Royalties, which is a great dividend stock, and of course our favorite coal miner here in Australia, Yancoal Australia. So I'll be jumping through those really quickly at the end, but of course, just as a start, a lot of the most recent policy making and economic data decision came out last night from the US with regards to their CPI. The last meeting that the Federal Reserve had, they increased the federal funds rate again, as was expected, up by about 50 basis points, that 3.5–4% range. Of course, that's increasing borrowing costs to a degree that we haven't seen since 2008, obviously the GFC. And this, of course, has different flow-on effects to the economy. But now the thematic and now the story has really changed as to what we can expect in 2023. So on the next slide here, we are expecting at least another 50 basis point hike coming out of the US Federal Reserve. The January CPI, which came out last night, showed a slight but not massive softening in the inflation rate. We're sitting about 7.1% annualized, which is okay compared to what we were seeing previously in the last few months, sitting about that 8.5%, but it's not as well, it's not as good as what a lot of people have been expecting. That's had direct impacts on the Nasdaq. The Nasdaq's gone up about 4 trading sessions in a row. We are seeing that as a little bit of a dead cat bounce, obviously. There have been primary concerns coming out of a lot of the big investment banks. Companies like Goldman Sachs, for example, cut about 3,000 jobs last week off the back of things like their net interest margins and their well, I could say lackluster investments over the past 12 months. So a lot of these concerns, the private sector is seeing a lot of weakening. And of course, the borrowing power for a lot of these businesses to be able to maintain their borrowing power with increased interest rate hikes is a major concern. So, and of course, as expected, we will be seeing more economic data coming out with regards to unemployment. But when we saw in September last year, the September US non-farm payroll, basically showing still very strong labor market there in the US. So that inflation is still going to be embedded for quite some time, a little bit. But taking a look at the RBA, which is the most important thing there, the December meeting, they decided to increase the cash rate just slightly by 25 basis points to 3.1%. The market was expecting a bit more of a higher rate, but the CPI 2022 inflation is expected to sit around 7.75%. As I've mentioned in previous webinars, a lot of the inflation that was seen over the last 6 to 12 months was inherently core inflation, which also is increased via increased housing prices and the domestic housing market, which is now obviously softening. We're seeing about a 10% decrease in property market value just in Sydney alone, and of course across other capital cities such as Queensland and Melbourne, seeing similar results. Of course, there are the outliers in particular, such as Adelaide, which has actually increased, but overall, this increase in, and of course a consequential decrease in domestic borrowing power has really seen a lot of these property markets not going exactly the way we want. So obviously the RBA is still focused on bringing inflation down to its core level at about that 2 to 3%. They are looking hopefully to adjust that. It's not really terminal inflation anymore, but they are expecting a inflation rate of about just slightly above overall headline inflation of 4% this year, and bringing that back down eventually to 2024, and hence that pivot that we're likely to see in the coming months. And you can see there, as I've mentioned, based on the futures market trading that is currently seen, especially the 30-day bank bills that the ASX provides, essentially, which is the conversion between different banks and the borrowing power that they're able to instill there. We're expecting a terminal rate of about 3.75% for the cash rate in 2023, and then looking to pivot a little bit and cut it back to about 3% in 2024. So we're looking here at the equity market. The S&P, as expected, this is actually a slide from one of our previous webinars where we forecasted what would be happening in the 2023 first quarter. And it's actually quite, well, I'm happy to say quite accurate as to what we were expecting. The S&P is still overall capped in a descending channel, but over the last couple of weeks, based on that softening US inflationary data, we are seeing a little bit more of an uptick coming out. The S&P sitting about that 3,500, 3,600 currently at present. And also the NASDAQ having four trading days in a row, as I mentioned before, hitting really terminal sort of levels at about that 11,000, but considering that's still about 30% less than what it was 12 months ago, we are still a bit hesitant to call the shots in and bring all our money back into the Nasdaq. There is still a bit of capitulation that has not yet happened. So we are expecting a bit of a retest of that key level there, about 3,000 points in the next 6 months. I put a little bit of a disclaimer there, of course, if inflation continues to be the main topic, which it will be. Inflation is one of the primary concerns, of course, not just for central banks, but it is the primary concern for general consumers in the economy, which is something that we need to take advantage of looking forward, and of course how we can actually utilize that for our customers and for our clients going into the stock market. So just domestically as well, we were quite accurate with this one as well, which I was pretty happy with. We saw a little bit of that market downturn on the ASX 200 in the last month of December of last year, and now it's come back a little bit. We're trading about that 7,300 point mark off the back of the CPI data that was released last night. And whether this level will be maintained remains to be seen, but we are still quite confident in terms of our overall strategy and what we're expecting Aussie inflation to do. Of course, the Australian market, I should say, is of course bolstered by the resources sector predominantly, our relatively low tax when it comes to mining, and our lack of red tape, as it were. So we're doing pretty well overall, especially in a few key commodities that we've presented with our clients, and they've actually made quite a bit of money. So going back off that, I just wanted to mention here, of course, just exclusively for our webinar viewers, just before I get into the couple of stocks that I've mentioned. But we have significant discounts obviously coming back into the office after a couple of years working remotely due to COVID. So now we're all back in the office, one big happy family, and we're getting these great discounts just for our webinar viewers. You can see there our best value, usually that diamond membership, where of course you get access to our daily financial report, which we have sent out prior to market open every day, discussing what occurred internationally and domestically, and what our commentary is on that. Of course, you get access to our high performing portfolios, particularly the mining portfolio, which has done quite well, and of course our income and growth portfolios as well. You have our technical analysis software tools, and of course the primary thing, which I think the vast majority of our clients say always is the highest value of our service is, of course, the actual ability to be able to speak to someone. You get your dedicated account managers, and you're able to have portfolio reviews and portfolio rebalancings, which have generated it's not necessarily just about making all the money in the world. A lot of people have different investment strategies, and we're able to help rebalance that portfolio and take a more overall view as to what you're doing wrong and also what you're doing correctly and how you can do it better. So a lot of people generate a lot of value from that service, and we've got there that 3-year diamond membership. It usually retails for $3,000 per year, which is honestly great value. But now we've got that 3-year diamond membership just for our webinar viewers, just sitting below $4,000 total, which is probably the best value that I think anyone could really get. But any questions that you may have, please feel free to call up the main line there, or you can give me a call directly on my mobile number, personal mobile number there, which is 0459 934 889, and that's Marcos. And of course, you've got access to our other portfolio managers and my analysts as well if you've got any particular questions, specifically when it comes to the stocks. So that's where I think that's what the vast majority of our viewers are looking forward to. The first one here that I'm taking a look at is Stockland Group Ltd. The ticker code for that one is SGP. Quite a familiar name if you've been to the Stockland's retail centers, the shopping centers there. Obviously, you can see from that image there, it's obviously very, very nice looking shopping centers, but that's not just all that they do. So you can take a look at this next slide. They've maintained quite, when it comes to the technical analysis, they've actually been quite significantly above the 50-day simple moving average quite consistently. There has been a little bit of a pullback over the last sort of 6 months, but now really seeing a lot of strength and a lot of support sitting around that $3.60 level. We have a target price currently sitting at about $4.10, which represents about a 40% capital return specifically. But as I was mentioning previously, it's not just all about retail shopping centers. Stockland actually maintains a lot of their rental revenue from logistical and warehousing real estate, which, as you may know, the retail online and offices and office spaces are primarily dependent on the foot traffic and who is actually paying rents and maintaining that rental yield. Logistical and warehousing real estate, of course, is focused on your institutional clients, your big businesses, and Stockland has a whopping 99.9% occupancy rate, basically maintaining that almost all the real estate that they have, aside from that 0.1%, is owned and rented out, and have a rental occupancy rate of about that 99.9% and maintaining strong yields. So, they've been focusing primarily on the Sydney and Melbourne market, but they are also looking to invest outside that, and not just in Australia, but also overseas in New Zealand as well. So as I mentioned, finding a really great support sitting about that $3.50, $4 range. But the more important thing, of course, is the yield. So if you take a look at the rental yields there, so I just wanted to mention, particularly in the town centers, there have been, of course, differing results from various stocks, particularly companies like Vicinity Centres or Centre Group, which is SCG. They operate the Westfields shopping centres. Their foot traffic has been considerably lower despite the post-lockdown thematic, despite the COVID pandemic concerns primarily being over, but they haven't really seen an increase in that foot traffic and an increase in that rental yield. Comparatively, Stockland, those town centres have a rent collection percentage of about 97%, i.e. the shopping centres and the tenants that do exist there, 97% of them paid on time and everything's all good. So if anyone has an investment property, it's always great to have a tenant who always pays, and Stockland boasts that as well. So comparable sales post-lockdown, they have a growth of about 10.3% and a sales growth of 12.4% versus the pre-COVID corresponding period. So that would be about 2019. They've had really cumulative impact of interest rates have increases on their affordability, particularly in those logistical centres that I mentioned before. And they have a 7%, I think it was about 7.2% based on the most recent market price, 7.2% dividend yield. That's currently not franked, but you'll notice that with well, pretty much all REITs, real estate investment trusts, the reason that they are not franked is due to the trust agreement and the sort of legalities around that. So it's nothing to do with Stockland. It is an industry-wide standard, so that's not franked. But a 7.2% yield is nothing to be laughed at, especially now that the bank's still taking a little bit of a delay to pass those saving rates to consumers. I think the savings rate currently is sitting about 2.53%. So having a 7% yield is not too bad, and it's definitely a great one in terms of capital growth and longevity as well. It's why we really like it. But another great one that we have, which is probably one of my favorites, is a company called Datura Royalties. Ticker code there is DRR. Just focusing on the next slide here is quite a few things to mention just quickly, but just in case you've never heard of Datura Royalties before, it's probably the simplest business model that you could ever see. It's a streamlined business, and essentially the purpose of Datura is to focus on a royalties business. So for example, their primary south flank, it's called the Mining Area C. It's a Western Australian iron ore mine that they essentially established via drilling results, and had a really well established mine there. They've essentially gone out, and BHP maintains mines, does all the operating costs for them, and Datura receives about a 1.2% ongoing royalty, a long-term ongoing royalty for the full management of the mine via BHP, and essentially that's just passed on to consumers. So and particularly that mining area C is the world's largest iron ore hub, that entire jurisdiction where they have their flagship project, and they have low cost and low carbon emitting iron ore, which is great, especially compared. A lot of clients have been focusing, I've always been asking, for example, about companies such as Fortescue Metals, which do boast a slightly higher yield than that. But overall, in the long term, we're not really sure if that thematic can maintain, if they can actually maintain that dividend stability. But Datura has made about 100% dividend stability, and their dividend yield is currently sitting about 7.1%. That's not concerning, and that's not taking into account any further catalysts for the share price as well. And I think this is a great one, which really summarizes the actual strong points, the strong financial performance of the company there. You can see revenue was about 265 million, right? And if you know much about, if you like financial statements as much as me, you can see the EBITDA, which is the earnings before all the other stuff, the annoying taxation stuff. They have a 97% EBITDA margin, which is pretty much ridiculous. So as I mentioned before, very, very minimal, almost no operational costs, as I said, because BHP are maintaining and mining that ore for them. So the EBITDA margin is about 97%, and all that net profit, 100% of that net profit is paid out to shareholders, which is pretty fantastic. So they had about a 22-cent final dividend last year, and a full year dividend total of financial year 22 of 33.76 cents per share, I should say. And on top of that, as with regards to their further catalysts, they had a capital growth return of about 20% in the last 6 months, coupled with that yield. And we have a target price for DRR sitting about just north of $5, $5.10. That's another 10-15% growth, not including any further potential mine acquisitions that they could receive. So that's a really great one to pop on your watch list and have a look at. Datura Royalties, DRR. And our final one, as I mentioned at the start of our webinar, probably one of the best recommendations that Stock Specialist made last year with regards to Yancoal. Everyone's heard of Whitehaven and your New Hopes, but they aren't necessarily the be-all and end-all of Australian coal. Yancoal focuses primarily on that thermal brown energy making coal, and you can see there, I've mentioned this stock a couple of times, but since the start of February last year, massive increase in that coal price, still currently trading about that 400 US per ton, which will be pretty stable going into the next 6 months focusing primarily on that thermal brown coal, which is used for energy production, particularly after all the supply chain issues coming out of Ukraine and Russia. They had, off the back of their September quarter, about 3.5 billion in cash, with projected, and we do obviously have to make sure we don't know whether this yield will be maintained, but we're pretty confident. But based on the last dividends that they have provided out to shareholders, the projected dividend yield for Yancoal is sitting just about that 20%. Yeah, you heard it correctly, 20% dividend yield. So that's pretty fantastic. The only concern, of course, which have been happening for a lot of, well, pretty much every coal company on the ASX, it didn't come with a degree of franking due to the unpaid tax over COVID. But a lot of these companies have been paying heaps of tax now that they're making money. So that franking credit percentage will be focused and coming up this year. Yep, so just focusing right on there, as I said, particularly with the thermal coal, it's not the metallurgical coal, which a lot of steel makers utilize to produce steel. But year to date, the Yancoal, that shouldn't be year to date, since we initiated that coverage, in the last calendar year, they've maintained about 120% capital growth. And in the last month and a half, have represented over 40% capital growth. And as I said, excuse me, as I mentioned as well, that dividend yield of upwards of about 18-19%, pretty fantastic for anyone looking for a good dividend stock. So you can't really get much better than that. It's finding strong support on the technicals. You can see there the RSI is slightly oversold. So we're looking for a bit of a pull up, sitting on that target price with a 9-month time horizon that we've got there for Yancoal is sitting about 8.58. The current market price, I think, is, I believe, about $6.20, which is still another 50% almost capital growth, which is really fantastic, especially when you incorporate that dividend yield there as well. So as I mentioned at the start of this webinar, hopefully everyone's enjoyed that so far, but I have a special guest this afternoon who's decided to join us. I have our senior equity specialist, Cameron Page, who, as soon as I mentioned to him that we were going to do a dividend yielding stock webinar, he had to mention his hidden gem dividend stock. So I've got Cameron here with me now. Thank you so much for taking the time here, Cameron. Tell our webinar viewers what you think about this hidden gem.
Yeah, no, thank you very much for having me there. So today we do have a hidden gem, growth and income stock for our members today. This company, they're currently trading around $2.13, 7.2% fully franked dividend there at the moment. Company's been in business for over 40 years. So what they do, they manufacture military grade steel products. They get a lot of consistent cash flow coming from the mining giants, BHP and Rio Tinto. Now, a lot of you are probably holding, one or both of those companies there. And, as you're well aware, obviously they're not going out of business anytime soon. Now, as a research company, which we are, we obviously like to look, where the smart money's going. I'm sure you all remember ex-Prime Minister Malcolm Turnbull. So he didn't last too long in leadership. He is known as a well-renowned investor, however. He took up a 6.38% stake in the company, acquiring about 3 million shares recently there. So, what's better than the high conviction, of an ex-Prime Minister in a company looking at government defence contracts, right? So they are aggressively expanding overseas, targeting that defence sector, securing government defence contracts. Okay, a lot of you, if you follow Ukraine, Russia, the military conflict there at the moment, a lot of you would know, you would have heard of the Bushmaster. Okay, so it's a military vehicle. It's the specialized steel. There's never been a single casualty inside this vehicle. And this particular company there, they've got a monopoly on this entire market. So as I mentioned before, currently fully franked dividend there of 7.2%. Definitely can't sneeze at that. And in terms of our growth target for the year, we're looking at around $2.80 for the target end of year.
Fantastic. And that's about a 40% capital growth as well. So, focusing on that, that's just the hidden gem that we've got for us. And just for our webinar viewers as well, for anyone who decides to take a look and instill a bit of interest into those hidden gems, we'll be able to provide you the ticket code for that company. But thank you, Cam. Thank you for taking the time to let our webinar viewers know about this hidden gem, and really appreciate it. So as I mentioned before as well, those webinar prices that you see there, just exclusive for you guys. And if you've got any particular questions on anything that we've discussed here in this webinar with regards to stocks, dividend yields, or the hidden gem, of course, that Cameron mentioned, feel free to give us a call either on the landline there or just my mobile number as well, which is just 0459 934 889. And thank you so much, everyone, for viewing this webinar. I hope you enjoy the rest of your Friday and have a fantastic weekend. Thank you so much.